Imagine this scenario for a moment. For just 7 days, ships stop moving through one very narrow waterway in the Middle East. No missiles are hitting cities. No oil fields are being destroyed. No global war is declared. But within just a few hours, oil prices jump, stock markets begin to shake, shipping costs explode, and fears of inflation come roaring back. That critical waterway is the Strait of Hormuz. And today, we're going to break down exactly what would happen, step by step, if it were to close for just 1 week. So, why does the Strait of Hormuz matter so much? Well, it's one of the most critical choke points on the entire planet. Every single day, roughly 1/5 of the world's total oil supply passes through this narrow corridor. This includes massive volumes of oil from major producers like Saudi Arabia, Kuwait, Iraq, the UAE, and Qatar. And it's not just about oil. It's also a vital route for liquefied natural gas, or LNG, especially for countries in Asia that depend on it. The thing is, there is no real alternative route that can quickly replace this volume. You can't just divert these massive tankers somewhere else. That is why even the slightest hint of a disruption in the Strait of Hormuz can send global markets into a complete panic. Let's look at day 1, the market shock. If the Strait of Hormuz were to close, even temporarily, the very first reaction would be psychological. Within hours, oil futures would spike sharply. Traders would immediately start pricing in the risk of future supply shortages. This would cause energy stocks to surge, while airline and transport stocks would likely fall. This is what's known as a risk premium shock. Markets don't wait around for confirmation that there's an actual shortage. They move based on fear and uncertainty about what happened next. Oil prices could easily jump 10 to 20% in a single day, driven purely by that uncertainty. Now let's move to days 2 and 3, the shipping and insurance crisis. By the second day, the real-world effects start to kick in. Shipping companies would halt the movement of their tankers. They would try to reroute vessels where they can, but many would simply have to cancel or delay deliveries. At the same time, insurance companies would react incredibly fast. War risk premiums for any ships in the area would skyrocket. Some insurers might even refuse to provide coverage at all. So even if the oil is there, ready to be shipped, it suddenly becomes too risky or far too expensive to transport. This is the point where the threat of a supply tightness becomes a reality. By days 3 to 5, the pressure spreads globally, and fears of an oil shortage become widespread. Countries around the world would start to react. They might begin to tap into their emergency oil reserves, those strategic petroleum stockpiles they keep for exactly this kind of situation. Governments would be scrambling to secure bilateral supply deals with any producer who can still ship oil. There would be intense competition for any available cargoes on the water. The nations that import most of their oil would suffer the most. This includes major economies in Asia and Europe, as well as many developing countries. At the pump, fuel prices would rise almost immediately, and this has a knock-on effect. It drives up food prices, transport costs, the cost of electricity generation, and manufacturing expenses. In short, inflation expectations would jump, and they would jump fast. This brings us to days 5 to 7, when central banks and governments are forced to react. As high energy prices persist, governments would step in decisively. You could expect to see emergency policy meetings being called. More countries would announce releases from their strategic oil reserves. There would be immense diplomatic pressure to reopen the shipping lanes, alongside an increased military presence to secure navigation through the area. Central banks, meanwhile, would become very cautious. Why? Because high oil prices can restart the engine of inflation. This could force them to keep interest rates higher for longer to control prices, which in turn could slow down the economy. This is how a simple 7-day disruption in a narrow strait becomes a major global economic issue. So, what happens to oil prices after those 7 days are up? Here is something most people get wrong. Oil prices don't just immediately fall back to normal once the strait reopens. The reason is that markets now have to price in the risk of this happening again. Even after shipping resumes, traders will remain fearful of another closure. Insurance costs will likely stay high for a while. The flow of ships will resume slowly, creating a backlog. As a result, prices usually stay elevated until a sense of stability is clearly and firmly restored. This is a perfect example of how even short disruptions can cause long-lasting economic effects. In a scenario like this, who wins and who loses? The winners would be oil exporters who have alternative routes to get their product to market. Energy companies and savvy commodity traders who bet on the price spike would also do well. The losers? Oil importing countries who would face a massive bill. Airlines and logistics firms crushed by higher fuel costs. And of course, consumers like you and me who would pay more for gas and other goods. Inflation-sensitive economies would also be hit hard. High oil prices aren't simply good or bad. They act as a massive force that redistributes economic pressure around the world. So why does this scenario terrify markets so much? The Strait of Hormuz isn't dangerous just because it might close. It's dangerous because it can close. And markets fear uncertainty more than almost anything else. A 7-day closure is more than enough to shock oil markets, raise inflation fears, slow down global growth, and trigger policy reactions worldwide. That's why every single headline you read about tensions in the Strait of Hormuz still matters so much. So, to sum it all up, what really happens if the Strait of Hormuz closes for just 7 days? Oil prices surge, shipping stalls, inflation risks rise, markets panic, and governments are forced to react. Not because the world's oil has disappeared, but because confidence has. And in our interconnected global markets, confidence is everything. If you found this breakdown useful, subscribe to Kuwaiti Dinar Analysts for calm, fact-based analysis of oil markets, currencies, and global economics. Comment below. Do you think markets overreact to the risk of a Hormuz closure? Or are they right to panic? Thanks for watching. See you in the next analysis.